All right, we are currently in one of the strangest economic environments we've seen in a very long time. Things are rough in the market, but the economy seems relentlessly strong. But the summer rally is over. So today we're going to talk about why we believe the bear market is not completely over just yet. And at the end, we're going to cover one extremely important thing that affluent investors do in order to make sure they go through periods like this with no problem. All right, so when we look at leading indicators like unemployment and wages, it doesn't at all seem like we have a recession looming. So with unemployment decreasing, corporations are still spending money to keep up with production, which does what? Makes inflation worse. This is going to put pressure on the Federal Reserve to continue hiking rates and doing things to help reduce that inflation, and in turn, more market volatility. There was a time when the media attempted to predict what the Fed's position was on the economy by looking at the Fed chairman's briefcase as he was crossing the street. The idea was that the more papers that were crammed in the briefcase, the more evidence he was using to try and position his more aggressive tactic in raising rates. This year, we've had 6 months of declining markets followed by 8 weeks of a nice recovery. Now, these 8 weeks have caused people to say, well, maybe it's over. Maybe it's time to start deploying money back again. You have to understand this absolutely critical point. Market rallies, or a recovery in the market during a bear market, is actually a pretty common occurrence. But if you think about how misleading these last 2 months have been for investors, we've talked to so many families who have been saying they're ready to redeploy that G fund back into stocks again. Markets have historically bottomed 140 days before the economy shows any sign of that happening. In fact, if you look at the average length of bear markets, taking out the outliers, the longest one and the shortest one, they average somewhere around 12 months. So here's a planning freebie. We talk about this with our clients all the time, and it's absolutely important that under no circumstance should you ever use economic indicators to determine your short-term strategies. A strong investment plan always starts with a good cash position. I'm talking about cash or cash equivalents, more preferably than cash. All right, so next point. Not all market recoveries are created equally. Most investors these days are accustomed to what we call a V-shaped recovery. Now, when we look at a V-shaped recovery, you can see here that we do have the traditional market that goes down, but it quickly rebounds, kind of giving you that V shape, or other people call this the check mark. Similar concept. Now, technology helps with this, which has been a big reason that markets have reacted so quickly. But the other reason is that the economy has absolutely been running on jet fuel for the last couple of years. So remember 2 summers ago when the whole world was ending and the economy was going to collapse as a result? How do you prevent the economy from collapsing? You inject jet fuel in the form of economic stimulus to the economy. And so what did we get? We started off with stocks prices as high as the moon. And this is what so many federal employees just have not grasped. That wasn't a good thing. Yes, you're looking at your portfolio values, it's the highest it's ever been, but those prices were not sustainable. But the thing is that we find too many investors believe that that's kind of their new high water mark for them. They are waiting for the markets to go back to those January highs again and kind of expect that V-shaped recovery as we rush back to that high. But this is the thing people have got to realize. During a bear market, it's actually common for us to see lower highs than the ones that we had before. But this means that markets can appear to be recovering and give people a lot of hope, but they're actually leveling off and may continue to decline. Just when you think you are recovering those losses, you get whacked again when there's another cliff fall. So what might this look like instead of a V? Well, I'm so glad you asked. There's actually something called a U-shaped recovery. I know, economists are so creative with these names, it's unbelievable. Here we go, back to the drawing board. So this is a slightly different picture, and in fact, when we look here, you can see that it's not really a check mark. It's much more U-shaped over time, and this bottoming out portion is what we're talking about when investors begin to feel like they have hope as they start to receive new highs just before being let down again. You have to be able to understand what kind of investment strategies you need to take during these times too. Now, this eventual type of recovery, this much slower recovery, this is something people are not used to anymore. This is something that used to happen. These days, people are looking for those check marks. They're looking for that new high. They're very optimistic and feeling very, as we would call, bullish about the markets as a whole. But that can be dangerous because, especially if you're retiring or you're already retired, you don't have that time to be able to recover any kind of losses if that protracted period of time goes on. Okay, so here's another planning freebie. So we've just come out of that COVID-19 pandemic scare, and that market volatility that we saw is something that is on our minds, and it's still very fresh. So unless you have ice in your veins, a U-shaped recovery where that bottom and that volatility kind of hangs around for a little bit, that creates this immense cognitive dissonance about decisions surrounding your wealth. And as a result, you become your own worst enemy. All right, so next point. We get back-to-back 75 basis point rate hikes, and at the same time, corporate profits are still at all-time highs. This should not be happening. The fact is that if the Fed can't control inflation, they have to send the economy into a recession. And obviously, that's going to send the markets into another tizzy. And the problem is that markets have a very unique way of leading investor sentiment. So when you see 8 weeks of market prices recovering, you want to get in on that action. But here's the big point. The most important thing you can behaviorally do to a portfolio is to completely remove the emotion. There is countless research about the benefits of a rules-based portfolio. So let's talk about these short-term market spikes. What happened? Over the last 8 weeks, we had the S&P 500 blast through its 50-day moving average. In portfolio management, that is a leading indicator of a trend. So what happened? Billions of dollars get shoveled into the markets by institutional managers because guess what? Those rules are triggering. We follow to see federal employee families saying, you know what? I think we're ready to put that G fund back to work again. And guys, if you get anything from the video, get this. That moment in time when you start to get that feeling about, you know what, I think it's time for us to put that money back to work again. That moment in time, a decision made not based on a plan, but rather one based on a feeling towards the market, is precisely why we say that investors become their own worst enemies. Okay, so I also promised that we would discuss what affluent families do to make sure that they're gonna be okay. And really, if you've been watching any of our videos, this should not come to you as a surprise. You ready? Create a plan. What? That's it? Wait. It's simple, but not easy. If you can put together a plan that outlines your timelines, your goals, your expenses, your cash flow, your investments, and make that all align in a way that supports what you're trying to accomplish, that will allow you to create an investment plan that will help you to meet those timelines, those goals, and so forth. Now, you might have rolled your eyes for a second, but I want you to stop and visualize this just for a second. Envision yourself with 50% of your TSP inside the G fund. And now you go to the office and everyone around you is talking about how they've participated in 10% of growth in their portfolio, in their TSP, over the last couple of months. Now, if you've saved well and you're later in your career, you're probably sitting on over $1 million in your TSP. So we're talking about a $100,000 jump here. How do you feel in that moment? Feels like you missed out, right? Now, what if that continues and goes up to 15%? Now you're starting to feel tempted to make changes in your TSP again. But is this what your plan calls for? Is this what makes sense in the context of your plan? Or is this just something that's based off of your emotions and your feelings at the time? You see, changes based off of predictions rather than a plan are very likely to lead to very costly mistakes. So if you're curious about more details on this, we're gonna put a link in the description. There's an article that goes deeper into more details. And if you want to learn about why a recession this year will look completely different than any unlike before, then here's the next video you need to watch. So until next time, stay wise and stay wealthy.